Many people do not think much about what types of account to invest their money, other than retirement accounts or taxable accounts. However, it may be prudent to consider the advantages and disadvantages of each type of account so that you can invest your money for maximum safety while minimizing taxes. This video will cover the advantages and disadvantages of using taxable accounts and retirement accounts, and the advantages and disadvantages of certain retirement accounts, and which accounts are best for certain investments. The main advantage of taxable accounts is that you can withdraw the money anytime, and you can contribute as much as you want. The disadvantage is that earnings add to taxable income every year, which means you will have less money to invest in the following year. Moreover, money held in non-retirement banking accounts are usually subject to creditor claims, and under bankruptcy, most states provide a very low exemption amount that can be protected from creditors. An exemption of $300 is common. The main advantage of retirement accounts is that earnings are tax-free or tax-deferred, depending on the type of account. Contributions to tax-deferred accounts are tax-deductible, and both contributions and earnings are not taxable until withdrawn. Roth IRAs and Roth accounts allow tax-free earnings and withdrawals, but there is no tax deduction for contributions. Retirement accounts also offer protection against creditors' claims. ERISA-qualified pension plans, such as 401ks and self-employment IRAs, are fully protected against both creditor claims and under bankruptcy. However, IRAs offer no protection against the claims of creditors unless you declare bankruptcy. Under bankruptcy, you can exempt up to $1.5 million from the claims of creditors. This exemption applies per person, not per account. This exemption is adjusted for inflation every 3 years on April 1st. The next adjustment will be in 2025. The main disadvantages to retirement accounts are contribution limits, and withdrawals are limited by tax rules, especially if you are younger than 59 and a half. Income from foreign securities is often taxed by the country of the issuer, regardless of whether the securities are held in a taxable or retirement account. However, the United States provides a tax credit or tax deduction for foreign taxes paid, but only if the securities are held in a taxable account. Consider this example. You receive foreign dividend income of $10,000 and pay $1,000 of foreign taxes. If you are in the 24% bracket, then your U.S. tax would be $2,400. Claiming a tax credit of $1,000 reduces your U.S. tax bill to $1,400. If you claim it as an itemized deduction, then your tax savings is only $240. As you can see, it will almost always be better to claim the credit. Note, too, that you can save or defer some U.S. taxes if the securities are held in a retirement account, but retirement accounts do not eliminate or defer foreign taxes. So if you want to invest more money than allowed by your contribution limits, then it may be more prudent to keep the foreign securities in a taxable account. The foreign tax credit saves more in taxes than the deduction, and can be claimed even if the standard deduction is also claimed. However, the credit is limited to tax liability, but unused credit can be carried backward for 1 year, then carried forward for up to 10 years. Qualified dividends and long-term capital gains receive preferential tax treatment. So if you receive qualified dividends or long-term capital gains on some of your investments, then it may be prudent to put these investments in taxable accounts if contributions to retirement accounts are already maximized and you qualify for the 0% rate. Otherwise, holding these securities in your retirement account helps to protect it against creditors. The 0% tax rate that applies to qualified dividends and long-term capital gains is only available if your income is below a certain threshold, which depends on filing status. But these income thresholds apply to all taxable income, including wages. However, these income thresholds only apply after subtracting the greater of the standard deduction or itemized deductions. If you are single and claim the standard deduction, then you can earn more than $58,000 and still be eligible for the 0% rate. For a head of household, the corresponding amount is $80,000. If you are married filing jointly, then you can earn almost $117,000 and still be eligible for the 0% rate. If you cannot maximize your contributions to an IRA, then contributing to a traditional IRA may allow you to contribute more, since it reduces your taxes in the year of the contribution. If you can maximize your contributions and your marginal tax rate is low, then it makes more sense to put your investments in a Roth IRA, since both earnings and withdrawals will be tax-free, which will be more important if you are younger, since earnings can grow substantially over the years. Or, if you want to contribute to both types of accounts, then put low-yielding investments into tax-deferred accounts, since they will offer the same tax deduction, but put higher-yielding investments in Roth accounts, where earnings can grow tax-free. Many people are deterred from contributing to retirement accounts or from maximizing their contributions because they fear they may need the money before retirement. A major benefit of a Roth IRA versus a traditional IRA is that the contributions to Roth IRAs, but not the earnings, may be withdrawn at any time without penalty, even before 59½ years of age. Withdrawals are considered withdrawals of contribution first, then additional withdrawals are considered earnings, so you will not incur a tax penalty if your total withdrawals do not exceed your contributions. But the withdrawal of earnings is subject to the penalties associated with unqualified distributions from retirement accounts. So be sure not to withdraw earnings. You can also withdraw money from IRAs without penalty if the distribution is qualified for reasons other than age, which includes withdrawing money for common expenses. For instance, you could pay unreimbursed medical expenses, but the distribution cannot exceed your total unreimbursed medical expenses, minus 7.5% of your adjusted gross income, or AGI. You can also pay for health insurance premiums for you, your spouse, or your child while unemployed, if your unemployment lasts at least 12 consecutive weeks. You can pay for qualified higher educational expenses for you, your spouse, or your child. You can withdraw up to $10,000 to buy, build, or rebuild a home, or up to $5,000 to pay for the legal adoption or the birth of a child, if the funds are withdrawn within 1 year of the adoption or before the baby's first birthday. You can also withdraw money without penalty if you become permanently disabled. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.